So, good afternoon, everybody. Welcome to the Kallanish Scrap and Iron Ore Markets webinar for June 2020. I hope you're all keeping very well, despite the difficult circumstances we face at the moment. I am the Kallanish editor for MENA. My name is Adam Smith, and I'm joined today by my two colleagues, Tom Gutierrez, who is our Asia editor, and Burçak Alpman, who is our Turkey steel journalist. And they will be giving you a bit of an overview of what's happening in the steelmaking raw materials markets, which have been rather unpredictable over the last few months, obviously because of the pandemic affecting the global economy, steel consumption and production. The format of this webinar will be the two presentations from my colleagues, followed by the question and answer session at the end. There will, during the presentations, be polls with multiple choice answers. We would encourage you to partake in voting in these polls. The voting will be completely anonymous, and your input and your views will really bring an interactive element to the webinar, which we are really hoping for. There is a questions and chat function in the control panel on the right of your screen. This can be used at any time during the webinar. If you have any questions that come to your mind during our two colleagues' presentations, then please feel free to put that in the box, and we will do our best to address it in the Q&A session at the end. There is also a handout section in that control panel screen where you can download the presentation, a copy of it to keep for yourselves. So without further ado, I will pass to my colleague Burçak Alpman, who will begin with a presentation on the scrap market. Please, Burçak.
Thank you, Adam. Good afternoon from Istanbul. I'll give you brief information on the latest progress in Turkish scrap market and a short-term outlook. Hope you enjoy it. Your feedbacks are highly appreciated. I will start my presentation with some brief information. In 2019, Turkey ranked as the 8th biggest crude steel producer in the world with 33.7 million metric tons of production, while global crude steel production totaled 1.8 billion tons. According to World Steel, however, production contracted in all regions last year with the exception of Asia and the Middle East. Worldwide global electric arc furnace production was unchanged at 523 million tons in 2019. Steel scrap consumption soared 15% in China last year to 215 million tons compared to 187 million tons in 2018, and underlines China's position as the world's largest steel scrap consumer. The increase was mainly due to the higher pollution emission standards for the Chinese steel industry. Most of the country's blast furnace mills have actively increased scrap inputs, and their steel scrap consumption in crude steel production ratio is currently set to be at 20.2%. 27.9% of the world's steel production comes out of electric arc furnaces, while 71.7% comes from blast furnaces. Coming to Turkey, as seen in the outputs based on different production processes, unlike the world, 67.8% of Turkish crude steel output is produced by electric arc furnaces. This makes Turkey Turkey steel production highly dependent on scrap. I'm unable to go to the next slide. Can you please help me with this slide number 6? Oh, okay, there I have it. Okay, sorry for this. Coming to Turkey, as seen in the outputs based on different production processes, unlike the world, 67.8% of Turkish crude steel output is produced by electric arc furnaces, which makes Turkish steel production highly dependent on scrap. Sorry, this was done before. This chart shows the price trend of Turkish imported HMS 80-20 in 2020. It shows daily price changes and represents Baltic and US origin HMS 80-20. Now we will examine which factors have been effective on imported scrap prices recently. But before this, we have a small poll where we want to see what you think about current scrap prices, which stand at 267 CFR Turkey right now.
So, ladies and gentlemen, now is your opportunity to vote in the poll. The question is, how do you see the current HMS 80-20 scrap price level in Turkey? And you have 3 choices. Select one of the following: healthy, low, or high. Please vote. We'll run the poll for about 30 seconds and then we'll reveal the answers. So we've got some answers coming in thick and fast now. Our participants are very active in voting. Thank you very much for that. So we'll run the poll for a few more seconds and then we'll close. Don't be shy, this is all anonymous, remember.
Okay, results are here, and most of our attendees find the current price levels healthy, which is good, of course. And the number of people who find it low is quite low, so this is good. So now we will examine what happened recently on scrap markets. Can we go one back, please? No, one back. Yes. Okay, the spread of coronavirus in major export destinations has caused buyers to halt their finished steel bookings. While this had a pressure on finished steel prices, Turkish mills have also exerted pressure on imported scrap prices, and they delayed their scrap purchases in March. However, due to the outbreak and lockdowns, the scrap supply in the world fell significantly. And when Turkish mills returned to the market in April to buy scrap, they have faced sharp price increases, as you can see on this chart. scrap prices has jumped from $207 to $245 in 2 weeks' time, and even exceeded $250 in the third week. However, rebar prices have failed to increase in the same rate due to the low level of demand, and thus scrap to rebar margin squeezed. After concluding satisfactory amount of scrap in mid-April, Turkish mills slowed their purchases and exerted pressure on prices, but scrap could only fall to 240 levels due to the tight supply. Turkish mills could secure satisfactory quantity of scrap only at about $250. In May, although many countries have eased their coronavirus measures, scrap supply was yet to be sufficient. On the other hand, China has bought very high quantities of billets, and iron ore prices have risen sharply at about $100. Coupled with the increase seen in Turkish steelmakers' demand and high duct prices in the exporter regions, scrap prices have shown slight increases. So, how was rebars performing during that time? Overall, rebar demand was low due to the lockdowns in many countries. However, Turkish mills were forced to reflect scrap price increases in rebar prices, as their margins did not let otherwise. However, they couldn't achieve to sell at offer prices due to the lack of finished steel demand and their customers' price pressure. As a result, rebar prices could only increase at $30, while scrap increased more than $50 in April due to the ongoing contraction in both export and domestic markets related with coronavirus outbreak. In May, with the ease of coronavirus measures all around the world, Turkish rebar producers were hopeful for rises in rebar demand. Towards the end of the month, they have seen significant increase in domestic markets after Turkish government announced new incentives for housing sales, such as delayed and long-term payments and lower interest rates for buyers. With the hope of better market conditions both in domestic and export markets in July and August, and as a result of increasing scrap prices, they have increased their rebar quotes. Current offers stand mostly at 420, 430 FOB levels from Turkey. This graph here shows the trend of HMS 80-20 CFR Turkish scrap and Turkish rebar FOB prices since 2015. As you may see, the margin sometimes tightens and sometimes widens, but most of the time they follow similar trends. Between 2015 and January 2020, average margin between scrap and rebar appeared at $174.2 with high fluctuations, as you can see on this graph. The red line here shows the average margin, while the blue line refers to the average cost. We consider $160 as average rebar production cost from scrap, but it's a very rough calculation, of course. It is based on scrap prices at approximately at $200. The higher the scrap price means, the higher wastage, which increases the cost. On the other hand, there are many factors affecting this cost. These are capacity utilization, energy, the capacity, whole capacity of the mill. So this 160 refers to full capacity utilization. At the moment, with low capacity utilization rates in Turkey, the average cost must be way above $160. As you may see, since January 2020, it has been above the average margin only a few times, and several times it has appeared even below the average cost. Although it hit $142 in January and in May this year, it has then recovered and currently stands at $158.5, slightly below average cost. So if the scrap and rebar margin is even below average cost today, how is the situation with billets? As you can see on this chart, for today, producing rebars from billets is more advantageous versus producing from scrap. When the margin between billet and scrap prices widens, scraps gets the advantage, but most of the time, producing from billets is more advantageous, as you can see on this chart. Alternative graph demonstrating the cost of rebars produced from billet versus scrap. Today, when billet price is at 385 and 390 CFR Turkey, and the scrap price is at $267 CFR Turkey, there's a difference of approximately $17.8 between producing from scrap and billet, with billets having the advantage. So before sharing our outlook with you, we would like to see where you see the prices in the coming period. Here comes the second poll question.
Okay, ladies and gents, here's your second opportunity to vote in the poll. You know how it works. The question is, where do you see the CFR Turkish scrap price level in July? Select one of the following: below $250 per ton, between $250 and $260, between $260 and $280, between $280 and $300, or finally above $300 per ton. Once again, a reminder that voting is completely anonymous, and we are really looking forward to receiving your views. So the votes are coming in now fast. We've had a good proportion of participants voting. Good to see people are partaking in this interactive element. We'll bring the poll to a close shortly.
Okay, so as most of our attendees find the current levels healthy, they expect it to remain between 260 to 80 levels, which is understandable. And some of our attendees expect them to decrease to 250 to 260 levels. And only a few of our attendees expect scrap prices to go below to 250. Okay, thanks for your votes. And now here is our outlook. Turkish mills are expected to face limited demand in export markets. In addition to the quota implementation, the EU has initiated anti-dumping and CVD investigations against Turkish HRC. European steel producers last week urged the European Union to slash import quotas, warning a potential flood of shipments threatened an industry already hardly hit by the COVID-19 pandemic. On the other hand, Canada started an investigation against heavy plates, and Egypt is getting prepared for a 10% import duty, and I think we'll hear more of them as a result of contraction in demand. So we are expecting protectionist measures to increase. The limited demand will cause buyers to exert more pressure on prices. An early arrival of the rainy season in China's southern region, where construction activities are usually higher than others, leaves demand for construction materials uncertain. On the other hand, demand for physical steel is held up by the optimism in the futures market. When the situation is so, it is worrying to think what will happen if the support from the futures market weakens. Also, inventories are expected to reach their highest levels with the arrival of recent imports. And the most recent updates regarding the new coronavirus pandemic in Beijing is one of the concerns. Turkish domestic demand is expected to remain strong following new incentives announced by Turkish government, such as Billet and long-term payments, loans with low interest rates for auto and house buyers. So Turkey's steel consumption is expected to remain strong. Actually, Turkey's steel consumption dropped 40% in the second half of 2018 and 15.4% in 2019. 2019 consumption totaled 26 million tons. While we were expecting to see a recovery in 2020, actually we have already seen recovery in the third quarter of 2019 and first quarter of 2020, the consumption was hit by the coronavirus in the second quarter of 2020. However, Turkey is still one of the sole countries, together with Vietnam and China, where consumption is expected to increase in 2020. World Steel expects global demand to contract by 6.4% in 2020. In China, however, it's expected to increase by 1%. Second wave of the virus is a big threat on steel markets as number of infected people have started increasing following the ease of restrictions. People have, I think, too much relaxed and acting like coronavirus never existed. Although global steel market is yet to survive from the damages of the coronavirus, investors and industries are bullish sentiment still give hope for Turkish steelmakers, and we observe a quite optimistic sentiment in the market. Coming to the, sorry. On the rebars market, however, we are not expecting to see much development on the export markets, though domestic market is expected to remain strong. Considering all these facts, we are expecting a softening in scrap prices up to the end of June. During the next month, we expect volatility to be diminished compared to previous months. But of course, there are facts that impact the prices and are unpredictable, such as political developments, trade wars, new anti-dumping cases, sudden changes in foreign exchange rates, or the second wave of the virus. This was the end of my presentation. Hope you enjoyed it. Thanks for listening. Now I'll hand over to Adam.
Thank you very much, Burçak, for a very intriguing, insightful presentation there on the scrap market. Just a reminder to everybody, if you have a question about that presentation or one about the presentation which is to follow, then please don't be shy. Put it in the questions box on the control panel on the right-hand side. We've had a few questions already, which is brilliant. and we will endeavour to answer those at the Q&A session at the end. So without further ado, I welcome my colleague Thomas Gutierrez, who is our Asia editor, as I mentioned at the beginning, and he will be giving you an overview of the iron ore market. Take it away, Tom.
Thanks, Adam, and thanks everybody for joining us today. I'm going to focus on iron ore. As any of you who know me will know, my focus is largely on Asia and China, so I'll be talking a little bit about China as well and how it relates to iron ore. Okay, so the first thing is obviously prices have gone up over $100 again, and it had not been on many people's list of expectations at the start of the year. The headline of this slide is, again, seriously. It's a slightly light tone, but it's a serious question. How similar is what's going on this year to what happened last year? In both years, we had a situation where prices were considerably below 100. And then we had an issue around Brazilian supply, which helped push prices unexpectedly over 100. So obviously in 2019, we had the tragic tailings dam disaster at Brumadinho, and this year we had the tragic COVID-19 situation. The impact of that has obviously been slightly different, and obviously for COVID-19 it's had a mixed impact. So initially, for most of the year, the spread of COVID-19 has been impacting steel production, steel demand, and iron ore demand globally. And so there's been a question as to how iron ore prices could be sustained. But as that situation spread to Brazilian supply, and Brazilian supply had already been impacted earlier in the year, Chinese port stocks continued to decline despite everything that was going on in the Chinese economy. And so now that we're in a situation where Chinese port stocks have declined significantly, prices are now sustained and quite well supported over $100 a ton. So the question then is, what does that mean and what happens going forward? But before I tell you what I think, I'd like to hear what you think. So we're going to run our poll now. Adam, if you could put up the poll.
Absolutely. So here we go, ladies and gents. The question is, how long will iron ore prices remain around or above $100 per ton? Will it be for 1 month, 1 quarter, or until the end of the year? Lots of people have an opinion on this one. The votes are coming in extremely fast. Still coming in. We don't have a clear winner, so to speak, yet. But there are some seconds remaining. Please vote if you haven't done so already, ladies and gents. We will close the poll very shortly.
Great, thanks, Adam. Well, it is very close, actually. The three options, 1 quarter of strong prices is the favorite, 39%, but only 2% higher than expectations of a much shorter stay above $100 a ton. A minority, slightly less than a quarter, saying prices will be high until the end of the year. Well, that's a very interesting result, I have to say. I'm going to go in here and show you a little bit more of what we expect. Okay, so we're essentially talking about 3 different scenarios here. And I have to say, you voted for our base case, which is the assumption that prices will remain supported more or less for a quarter before sinking. So the basis of this is that iron ore prices will remain supported until either Brazilian supply picks up and global supply picks up, also some other suppliers like South Africa, or Chinese demand weakens. So our base case is that Chinese demand will weaken only slightly over the summer. Steel market inventories may at least bottom out, may increase slightly, but there won't be enough pressure on Chinese steel markets for iron ore to be pushed lower. The second scenario is also the second favorite option among our attendees today. That is that iron ore prices will sink further, and that would be on the assumption that the Chinese steel market does weaken more noticeably over the summer. Obviously, we have a slight slowdown in the summer. Typically, we have the rainy season in southern China. We have, very hot temperatures which slow down construction and so on. And on top of that, of course, we have the huge wave of imports, which we'll talk about a little bit later. And there is some fear that if that triggers an increase in inventories, that will put pressure on Chinese steel prices and perhaps push iron ore prices also under 100, particularly if Chinese production, steel production, begins to be pushed lower. The final scenario is that prices can stay higher. Now, this is our third option and our least likely option, but it's worth bringing up. At the moment, Chinese steel demand seems pretty strong, and there's quite a lot of support for the Chinese economy. Inventory levels have fallen fairly rapidly so far this year, even though they're a little bit elevated year on year. Steel production and steel demand are at record highs in China. So what happens if we get to later in the year and we find that the situation in Brazil, for example, has not been resolved, if the coronavirus continues to spread in Brazil, or if there's another outbreak? Could we see another tightening of supply while we still have strong demand in China? So it's something to look out for. Obviously, this year there's a lot of balls in the air, and everybody's trying to juggle all of their predictions at the same time. It's not been easy. So let's talk a little bit about the situation currently. Firstly, in terms of iron ore supply, seaborne, Brazil is really the main driver there. Obviously, there are some smaller suppliers that are also having issues with supply. But if we look at Australia, we're actually seeing quite strong shipments so far this year. So in fact, if you look year on year, this is just Port Hedland shipments as an example, but shipments have been pretty strong, pretty constantly since March. And if you look at year-on-year growth, you're looking at around 6% year-on-year growth in shipments. In fact, the shipments from Australia have actually kind of balanced out the year-on-year loss in Brazilian shipments. So China's total iron ore imports are actually up year-on-year. So when we're talking about tight supply in the iron ore market, we're really talking about an imbalance and not a year-on-year decline in supply. Obviously, supply a year ago was affected very heavily by the disruption to Brazilian shipments, so perhaps it's an unfair comparison year on year, but nevertheless, import volumes are higher. We also have this ongoing issue of Chinese domestic iron ore supply. So, historically, there have been periods when a high iron ore price would trigger an increase in Chinese iron ore supply. But that has not happened in recent years, and you can see from this data, there's a very obvious disconnect in the market. The real issue is that Chinese domestic mines have been closed down if they're unsafe or they're small, or if they're private and not officially run or don't have the right connections. And so the flexibility of supply has reduced. So there's no replacement for that lower Brazilian supply. But the other key factor is really the demand side, and it's the demand side that I think is crucial in Chinese and global steel markets right now. If we look at Chinese steel production now at record highs, this is the CISA 10-day data, but we also, of course, had the official data for last month for crude steel production, running at well over, or at least noticeably over 1 billion tons a year for the second month in a row. That has been driven really by strong demand. So we now expect finished steel demand in China to be up 2.2% this year to 907 million tons. And on the back of that, crude steel production will be able to grow almost 2% to 1.008 billion tons. So these figures are from China Steel Intelligence. So if you want to get a better idea of our thinking behind that, then please feel free to reach out to us and we'll send you an issue. But you can see really that high steel demand and the resulting high steel production is really at least half, I would say, possibly the greater half of this iron ore story right now. So a lot of that has been driven by support for the economy. So this is just a few examples of what came out during the two sessions a while back. Some of this was disappointing in terms of sentiment. Expectations had been driven very high prior to the meetings, and so some of the announcements, for example, the fact that there will be no GDP target, were read as fairly negative in the short term. But on balance, if you look through the actual measures, it's impossible to say that there's no support for the Chinese economy. We have, a very high central government fiscal deficit. We have trillion RMB in coronavirus bonds. You have an additional 1.6 trillion in local government special bonds. Another very significant wave of tax cuts. And you also have now there is talk of bond issuance in order to support urban reconstruction, which could be another factor to support Chinese construction steel demand. So there's quite a lot going on and quite a lot of support for the economy. So it is logical that the Chinese steel demand currently is at a record high. Because it is at a record high, China is really importing anything it can. Now, we noted in last year's China scrap report that the ban on scrap imports was going to backfire on Chinese steel markets, and we expect Chinese scrap supply domestically to be below notional demand for at least another 4 years. So we did not at the time anticipate that it would be quite such a restriction on the scrap market, but obviously in the absence of the ability to import scrap, China has now begun to import everything else. So that includes finished steel, semi-finished steel, DRI, pig iron, and it is scouring globally. If we talk to some of the Chinese traders based overseas that are trading in steel, they are now looking actively at any market they can to buy pig iron, DRI, and semis in particular. Finished steel less so, but there is a significant amount of finished steel coming. And if you look at this chart, this is only going up to April. So this is leading up to the peak in arrivals. So there are reports now of several million tons coming, potentially as much as 9 million tons arriving by the end of August. There's some doubt over how much will actually arrive because some has now been diverted away from China, which we can talk about later if somebody asks the question. So with this in mind, the question is really what will change the market going forward? So we said before, the main shift is, will Brazilian supply recover? We're working on the assumption that it will, unless the coronavirus there becomes considerably worse. And that will be a slow but steady process. So it will not recover in the next month, but it will recover over the next several months. And then the other side of the question is, will demand fall? Well, Chinese demand might fall a little bit from record highs in the coming months, but we expect Chinese demand over the year to be remarkably strong. There's a caveat there in that if China allows scrap imports, then that would upend global markets quite significantly. However, we've spoken to CISA and CAMU and several of the other players involved, and they have all said that that's extremely unlikely to happen this year, although they would like it to happen next year. So that's our base case, is that the iron ore price will remain strong for a quarter, bearing in mind this risk that Chinese steel demand could be weaker and Chinese steel inventories could increase over the summer, which could create some problems. I'm going to leave it there, but I look forward to answering your questions. Adam and Burchak, if you want to come back.
Thank you very much for that interesting presentation, Tom. We are going to do a question and answer session now, and we'll be taking the questions that our participants have asked during the presentations and putting them to our presenters. We've had quite a few questions, which is great. We won't be able to answer all of them, and those that we cannot answer, we will endeavor to do so later after the webinar in an email. So if you have asked a question which doesn't get picked right now during the session, do not worry, we will address it after the webinar. So one interesting question we've had for, I guess this would be for Burchak, the dynamics in the finished long steel segment. How do you see them supporting scrap prices in the near term? How do you see the development of finished long steel demand in the short term supporting scrap prices?
Thanks for the question. Actually, we are expecting domestic demand to remain strong. Turkish steelmakers are expecting an increase of 3% in steel demand this year compared to last year. But I think there should be support from export demand as well. And I'm not expecting a huge change in export demand, as you know, we have the protectionist measures all around the world. We have the threat of the second wave of the virus. So it is most likely, you know, of course, demand is very important on scrap pricing, but domestic demand will be the driving factor on Turkish mills' scrap purchases, I think.
Thank you, Burchak. Tom, you already touched on this in your presentation. You talked mostly about the iron ore market, but of course, Chinese scrap imports are a very important factor. We had a question asking why are authorities actually, why have they placed these restrictions on scrap imports into China? And if you could also expand a bit more on when, if there is any sign of when you expect these restrictions to be loosened or eased.
Yeah, sure. So the ban on scrap imports is it was initially really a byproduct of the move to ban scrap plastics. So there was a problem with import of wastes. A number of countries in the last couple of years cracked down on the import of waste for recycling. China was obviously one of the biggest importers, but you also saw similar moves in Malaysia and elsewhere. And scrap was simply caught up in that. At the time, for the local scrap industry, there wasn't a lot of complaint about it, and the reason for that is that they are in a phase where they are really aggressively pushing investment in scrap recycling and consolidation of the scrap recycling sector. And they, in a very kind of traditional point of view, saw imports as a threat. You know, better to have the market for yourself, allow the market to develop and invest in itself before you allow competition for imports. So they saw it as perhaps a lucky coincidence that it occurred at a time that they were developing their own industry. Now, however, the demand for scrap has become so significant that there's a very obvious imbalance, and the China Association for Metal Scrap Utilization has been lobbying for the ban to be eased. There had been rumors earlier in the year that it could happen as early as September, but I spoke to Li Shubin, I spoke to analysts at CISA, I spoke to Li Xingchuang at MBI, and even though all of them are in favor of easing the ban, none of them actually expect it to happen that quickly. So I think if they don't expect it, I think it's extremely unlikely. I think it could happen next year, in which case it could be one of the policies that's approved in the next 2 sessions, maybe next March. But who knows, sometime next year seems likely.
I see, and following on from that, what would be, in your view, the impact if China were to allow scrap imports?
Well, right now, as I said, China is importing absolutely anything it can, and if it switches to importing scrap, that can be very significant. If you look back at 10 years ago during the financial crisis, when international scrap prices were very low and China saw an opportunity to import scrap, it became the second largest importer of scrap globally. It was importing pretty much as Turkey. So if you imagine the scrap market with a second Turkey, obviously scrap prices are going to be volatile, to say the least. And that's going to have a knock-on impact on other markets. For example, EAF producers are going to be increasingly disadvantaged. It will return some advantage to Chinese blast furnace producers. It may mean that China starts importing more scrap and exporting more steel rather than importing finished steel. Certainly, I think the finished steel import markets into China would close down, but potentially semis and scrap would survive. But finished steel markets would return to being Chinese export oriented. So it would be another reversal in the market in a whole range of different markets.
Interesting. Thank you, Tom. Burçak, during the COVID-19 pandemic, we've seen many Turkish producers reduce, if not stop, production altogether because of the difficult situation with demand. What is the current, from what you've gathered, the current most up-to-date utilization rate of Turkish steel producers?
It is slightly over, it's slightly over 50%, 55%, yes, 55% levels.
Okay, so still relatively low and has room to grow as demand hopefully recovers. And considering we're talking about scrap and iron ore in this webinar, when it comes to Turkey, obviously the majority of producers are EAF, electric arc furnace based scrap users.
Yes.
But which at the moment, which producers in Turkey, the blast furnace based or electric arc furnace based producers, have a cost advantage when producing, say, hot rolled coil at the moment?
I think they should have similar costs at the moment with the rises seen in iron ore prices. With a rough calculation and current raw material prices, I would say that electric arc furnaces have a little higher cost advantage for today. There's another way of verifying this actually. There's a very general empirical formula, and it says the ratio between iron ore and scrap price should be 1 to 3. If it's above this ratio, blast furnaces have the advantage, and if it's below, electric arc furnaces have the advantage. Today, with iron ore at $100, at over $100, and scrap at $267, the ratio still remains below 300. And this also verifies that electric arc furnaces in Turkey has a little cost advantage compared to blast furnaces in HRC production.
And following on from that, in the short to medium term, do you see an increase in the use of electric arc furnace steelmaking in Turkey versus blast furnace?
Actually, it is very dependent on Turkey's utilization rates, of course. And for the moment, we are expecting the utilization rates to increase to last year's values. Average 2020 utilization rate expectation is at 70%. So this means Turkey will need more scrap, and this will come from electric arc furnaces mostly, because it's easier for electric arc furnaces to decrease and increase utilization rates compared to blast furnaces. So the utilization rates in the electric arc furnaces will further increase.
Thank you. Thomas, maybe a final question to you before we wrap up. We have a question here from a participant about domestic iron ore supply in China. Why is this not picking up? There are suggestions that the increase in domestic production of pellets is locking up iron ore supply in China. How do you see the domestic supply situation in China for iron ore?
Yeah, so there's a couple of factors here. So one is in terms of actual iron ore mining. And on that side of things, what you see is a lot of these small privately owned mines have closed down. So a lot of the ability to increase the run of mine production of iron ore has been lost. So you have a subset of mines that are fairly constantly active at quite a wide price range, and those are the ones that are active, and there aren't many outside of that subset. So that is one factor. Another factor is that any increase is going to be muted by the quality of the ore and the use. So any marginal ton of run of mine production in China is going to be a pretty low Fe content iron ore, and so it cannot be used as it is. So adding 1 ton of run of mine iron ore does not equal adding 1 ton of 62% Fe fines. It's going to be 1 ton of maybe 20% Fe that has to be concentrated to a 65% Fe product. So you might need 4 extra tons roughly of new mining production to get 1 ton equivalent of a standard quality imported product. So there's also a bit of a mathematical issue there with just the quality of the iron ore and where it goes, and the fact that it goes into a processed product rather than being a product that can be used directly by steel makers. So there's both of those factors are limiting.
Thank you, Tom. We've had a lot more questions. Thank you very much to everybody for supplying us with your questions. We've run out of time now, unfortunately, but as I said earlier, we will endeavour to send out an email to everybody with answers to all of your questions after consultation with our other colleagues as well, who may be able to shed some light on the situation in more detail. I'd like to thank everybody for joining us today, for partaking in the webinar. I hope you found the content from my colleagues, very insightful and thought-provoking and very useful. A recording of this webinar will be made available tomorrow, so you will all be able to access that at your leisure. And I would also like to remind you that next week, Kallanish is hosting the Global Steel Markets June edition webinar, which will be on Tuesday, the 23rd of June. And we invite everybody to register and partake in that webinar. We will be delighted to see all of you and to receive all of your questions as we did today. So once again, thank you to my two colleagues for their fantastic presentations. Thank you once again for everybody, for joining, and take care, stay safe in these troubled times, and we will catch you again soon. All the best, everybody.